Hello everyone. I will continue with the remaining part of chapter 6 in this lecture. So we look at the types and uses of common stock. So one category of stock is the blue chip stock. So these are stocks of large, well-established firms who have a long track record of profits and dividends. So they are generally the leaders in their industry, and they are considered less risky than other stocks because they have a proven track record and they are expected to perform similarly in future. So they are suitable for investors who look for returns higher than bonds but have less risk appetite. Income stocks are those which have a long history of paying dividends. So it is suitable for investors who are looking for a continuous stream of income. However, there is a significant amount of interest rate risk. How to reinvest the dividends given the rate of return available at different points of time. It's generally the public utility companies who are seen to be income stocks or dividend paying stocks, because these stocks generally have limited growth potential, so there isn't any point in reinvesting profits in the company's business. Therefore, the companies prefer to pay out dividends to their shareholders. Growth stocks are companies which experience rapid growth in their sales and profits. So they pay little or no dividends, and they are suitable for investors who are looking for substantial capital gains. But there is also risk involved because companies may experience high growth, and at the same time they may also be susceptible to unfavorable business environment, and their share price may decline. The next category is tech stocks. It represents the technology sector, and it has become important because technology has wide applications in different spheres of life. So the companies can be risky, small stocks, or they could also be growth oriented, and even some blue chip companies which come under the tech stocks. So they have potential for high returns because technology sector holds a lot of promise. But there is also a lot of risk because technology sector faces disruption. The companies which are doing well, which are blue chip companies today, may decline because of technological disruption. So there is a fair amount of risk involved in tech stocks. Then we have the speculative stock. So these are stocks which have potential for a lot of capital gains, but they may also have a chance of significant decline. So their stock price is subject to a lot of fluctuations. And these companies do not have a proven track record of business or financial success. Now we look at stocks based on their response to the business cycle. So first is cyclical stocks. These are companies whose earnings are closely linked to the overall economy. If the economy does well, the stock prices increases considerably, but their share prices, the returns also decline when the economy is not doing well. So these are generally companies which are dependent on capital investment by businesses or large purchases by consumers. So these companies are cyclical stocks. Then we have defensive stocks. They are less susceptible to the economic cycle. So whenever the economy weakens, they still are able to do well. So they are an avenue of investment for investors who want to invest money and earn returns during a slowdown. So the stocks in this category are public utilities, food, and pharmaceuticals and so on. We also can consider stocks in terms of their market capitalization. Okay, share price into number of shares outstanding. So one category is large cap stocks. So these are companies with market capitalization of more than $10 billion. So they are fewer in number, but because of their large market cap, they account for a large portion of the US stock market. Then we have the mid cap stocks. So these are mid-sized companies, market cap between 2 billion and 10 billion. They have a strong potential for higher capital gains. They generally have some proven track record of business and financial success. And a special category among them are the baby blues. So these are companies which can become blue chip stocks in future. Then we have the small cap stocks. So these are companies with market cap less than 2 billion. They have annual revenues of less than $250 million. They have potential for high returns, but also the decline in stock price cannot be significant. So that is why they are not widely traded. And so buying and selling of this stock becomes an issue. So far, we looked at investment in domestic stocks. So foreign stocks are also becoming increasingly popular. One reason is stock returns in the US market has been outpaced by stock returns in foreign markets. So it provides a suitable investment opportunity for certain investors. So if we look at this graph, there are some developed countries who have generated higher stock returns on average. So what are the ways in which an investor can invest in foreign stocks? So one is direct investment. That is, the invest in a foreign company's stock in their local market. So in their local currency. In this case, availability of information may not be possible. There may be also the risk of currency exchange fluctuation. There could also be problems due to different regulations in the local country. So the other option is to invest in ADR, American Depository Receipts. So these are instruments where the underlying is the share of a foreign company and those shares are held in a bank. So US investors can trade in ADRs as if they are trading in the stocks of foreign companies. So how do we look at the return from foreign stocks? So we look at the total return from the perspective of a US investor. So it will be in US dollars. So we look at the total return in the local currency and add the return from currency exchange. So currency exchange rate represents the value of a unit of foreign currency in US dollars. So the total return formula would be the ending price of stock plus the dividends paid out divided by the beginning price of stock into the currency exchange rate at the ending of period divided by currency exchange rate at the beginning of the period. So what we notice is the currency exchange rate also has an impact on total return from foreign stocks. So if the dollar strengthens with respect to the foreign currency, it will have a negative impact on total returns. Whereas if the dollar weakens, it will have a positive impact. So you can refer to the formula in the previous slide and try to figure out an example of how a strengthening dollar impacts the total return and how a weakening dollar impacts this total returns. Now we look at some of the stock investment strategies. So what are the objectives of investing in stock? Investors may consider stock to be a safe avenue for investment, which generates above average returns. So they will go for blue chip stocks. Some investors may look for creation of wealth. So they are looking at capital gains or at dividend income. So they will go for growth stocks or they will go for income stocks accordingly. And for some, stock investment can be a source of income. So they will be looking for stocks which have high dividend payout. So these are some of the objectives of investing in stocks. So we look at different strategies which can help to fulfill these objectives. The first is buy and hold. This is where an investor will buy stocks of companies and will hold the stock for extended periods. So they will generally buy blue chip stocks and they'll expect to earn good returns or above average returns over an extended period of time. The next is current income. So the investors want to receive cash on a regular basis and at present. So they will go for stocks which pay dividend on a regular basis. So for them, current income is more important than capital gains in future. So investing in stock becomes a source of income for them. The next strategy is long-term growth. So in this case, the investor is looking for significant capital gains. So they will want to invest in growth stocks and they will frequently buy and sell stocks so that they can time the market. So they buy stocks at low price and expect the stock price to increase substantially when they might sell the stock. So one special category of this long-term growth strategy is total return approach. So in this case, the investor is looking for long-term total returns. So they are agnostic to capital gains and dividend. So they might go for companies which have a strong potential for growth as well as companies which have a strong track record of dividend payout. So they may go for either of them. Then the next strategy is aggressive stock management. So here the investor has a portfolio of stocks and they frequently do trades because they want to have capital gains and in a quick period of time. So in this case, they look at different stocks and they do frequent trades so that they can earn capital gains quickly. There are substantial risk involved because some of the investments may go wrong and it may not be possible to recoup the losses in a short period of time. Plus, frequent trading leads to a lot of transaction costs. The final strategy is speculation and short-term trading. So here also the objective is capital gains, but the investor is willing to assume more risk. So they may focus on speculative stocks, small cap stocks, or tech stocks because they have high income potential and at the same time high risk. Since the investor is ready to assume that risk, they invest in these risky stocks. Again, there is high risk involved of losing the investment as well as high trading cost because of the frequent trading done by the investor. So that's all for chapter 6. I will end here. Thank you.